Welcome to another weekly market insight where we try to sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week, as every week, is Chris Ahrens, one of our lead analysts with Gatewood Wealth Solutions. And we have special guest Jeremy Schwartz, Global CIO with Wisdom Tree, and Aneeka Gupta with Wisdom Tree as well, Director of Macroeconomics. I'll eventually get all those titles out there. Sorry, guys. And if you have not already hit that subscribe button, make sure you hit that subscribe button. We are really excited about these guests, and I'll let you kick it off, Chris.
Yeah, I think we have to start with Russia and Ukraine. And we've been saying for a while now that the market is really just moving headline to headline. And so do you guys think that's starting to move behind us, or how much of this conflict do you think is already priced into the market?
Maybe I could start, and Aneeka's obviously much closer to what's going on, so she should share her European perspective. So in the U.S., we actually just did a office hour segment with some of our clients yesterday, and we asked this question: what is the greatest risk for the markets today? And it had things like inflation, the Fed, and Ukraine, and only 10% of the people said Ukraine. It was sort of the Fed hiking too much or inflation as a top concern. For at least investors in the US. That's the narrative we've been saying actually with Professor Siegel, who I've worked with now for 20 years. He's been key saying the Fed is a key driver this year, that there is inflation that's going to be higher than most people had expected, and that the Fed would be aggressive eventually, not right now, but they're going to eventually get more aggressive. And that was going to create more of the volatility in the market. Obviously, you have this additional crisis and war in Ukraine, and that is creating further pressures and all sorts of issues, particularly on inflation, commodity prices, and other things. But Aneeka, anything you would say from the European perspective?
Yeah, I would echo that view. But I think markets tend to get a bit lazy when you don't see any headline news popping up. So I think that we're into day 27 of these geopolitical risks and the war in Ukraine. And I think, that puts investors in the backseat, and they kind of just are reacting to the more macroeconomic outlook. But as Jeremy said, the inflation picture is just getting accentuated due to the complications of the war. So at the background is the war. The war is front and center. It's just not being captured in the headlines, according to investors. And also, I think, we keep moving one week to the next. Moving in from a rally to a risk off to a risk on. And I think that was also, perplexing a lot of investors. So I think it is one of the key risks, but I think it's gone a bit in the back of investors' radars at this point in time, because they're looking at the reaction from the war as opposed to what is going on with the war, because nothing much has changed. And we went from last week of moving to neutrality, but none of that has actually taken to fruition. So yeah, that's how we are looking at it in Europe.
We see a lot of the energy as a component of what we're talking about whenever we meet, when we say Ukraine. Maybe it's almost a synonym when we're talking about Ukraine is energy prices. And it seems like it's a convenient excuse on why prices continue to rise, but inflation was already there beforehand. How much of the geopolitical risk of Ukraine is really driving the price higher, and how much of it is just the continual trend of inflation? I know Jeremy Siegel has been talking about that up to 20% because of the money supply increase. Is this just bringing that forward, or is there going to be a recovery if there's some type of tension reduction because of geopolitics?
Well, I guess there's a lot of the energy move was happening again before Ukraine, and it was the rebounding from the reopening of the economy, and the question is the long-term expenditures for mining and exploration and development. You're seeing a lot of the energy companies, their shareholders were burned for a very long time. And the energy sector has been a terrible sector for a decade, like underperforming by 1,000 basis points a year. So the energy investors have wanted to see more dividends and buybacks and not just a return to massive spending. So you've had less supply. And this is not just an energy phenomenon. This is, I think, a global commodity phenomena. And so I think you had this underlying pressure, and now you've got this additional war premium that's baked into it. And so the question is, Aneeka, do you have a sense, if you had to ballpark what you thought the war premium was in oil or commodities generally? And it's a very hard number to say.
Sure, absolutely.
Yeah, so I would pick a few commodities and a few sectors that are very closely reliant on Russia and Ukraine. So within the energy spectrum, you see the highest dependence, which is why we saw the highest rebound across the energy spectrum. And owing to which, I think I would say 20% of the price rise that we saw was purely linked to geopolitical risk. And we saw a lot of that unwind last week, when we saw the possibility of the US-Iran deal coming back on the table, where we saw alternative buyers such as India and China, looking at the price discount versus the euros to the Brent price, and wanting to take up that oil. And so we saw a bit of an alleviation to the supply side story. And we also saw, the possibility of some of that demand still staying strong. And so we saw a bit of a sell-off of the oil price. But I think the levels where we're at right now, around the 115, is reflecting the actual fundamentals within the energy spectrum. As Jeremy said, we've seen more than a decade of very low capex in the energy sector, and that is being reflected in the price. Yes, governments put their foot forward, on moving towards this energy transition. But let's not forget, we're not there yet, and we're not ready enough to wean ourselves off fossil fuels. So I think energy has seen a 20% premium baked in, but a lot of that came off last week, and the price today is reflecting current fundamentals. If we move further into the metal space, I think two very important in the metals, like base metals and precious metals. I think some of the metals again see a very high reliance on Russia and Ukraine supply. One of them being nickel, palladium, as well as aluminium. And just take for example, in aluminium, over the weekend we got news from Australia looking at it actually calling on restricting supply of alumina, which is a very important component alongside bauxite to produce aluminium. And as a response to that, we've seen the aluminium market tighten even more. So coming into 2022, the metals complex was anyway quite tight on supply. So the current Russia-Ukraine crisis is only exacerbating that. So I would say that fundamental prices in the base metal complex is actually well priced. We did see about a 5 to 10% geopolitical risk premium priced in there, but we saw some of it come off the week before last. But I think right now prices are reflecting true fundamentals. And then, moving ahead to the grains market, I think again, Russia and Ukraine are well known to be the bread earner for Europe. And again, there we see a very high dependence on Russian wheat and corn and Ukrainian corn. For the export market, Russia and Ukraine are like the 8th largest exporters globally. So we've seen a bit of a downgrade from USDA. And as a consequence, we've seen an unwind in price from a 76% year-to-date rise in wheat prices. We've seen some of that come off, but as of today, we're up about 49%, and I think that again is reflecting current fundamentals. So I think we have seen a fair amount of correction across the commodity complex, which is reflecting fair value in price.
So as you're mentioning, it's not just the energy story. There's fertilizer component, there's grains components, there's metals component, palladium. Another one is neon, and we've been dealing with a supply chain disruption in semiconductors, which require lasers, and neon is an important component to make lasers, and we need, it appears, more machineries to make chips. Are there other alternatives or other places that the market could go if this remains a place that's really offline or not able to provide the amount of commodity resources that they were prior to the invasion?
So in the case of fertilizers, again, you bring back a very important point, especially for the grains market. Fertilizer prices are dominant in Russia and Ukraine. We're looking at ammonia, ammonium nitrate, urea, all being very important supply sources from Russia and Ukraine, and hence there is a strong likelihood when you see these supply disruptions take place amidst very, very high prices, farmers tend to cut back on actually using these fertilizers, and hence that tends to impact crop yields going forward. So I think this has a more long-lasting effect, which
Mhm.
again could hold prices higher. Um, in the case of neon, I don't really have the numbers, in terms of how much of it is reliant on Russia, Ukraine. So I'd be able to give you less color out there.
Sure. Well, one of the things that we're dealing with is should we be adding any more commodities than we already have? When you see prices move this quickly, and I just remember March 14th, whenever Chevron announced it was going to be reopening things in Venezuela, that huge price drop. Are prices really unstable, and have they gone too far too fast, or is there going to be an entry point, or is it for risk mitigation? It's a good thing to add to portfolios despite the prices.
Let me start and give two things on both the commodities and then the companies, and then Aneeka can add on anything else. So there's two things. One is the current dynamics. I mean, this has been one of the most challenging years for a 60-40 portfolio, really in history, because you have stocks and bonds going down together. And bonds have had one of their worst starts in really 40, 50 years. And our view is that, again, inflation is a continued problem. It's going to be a bigger problem in our view for bonds than stocks because of just the TIPS bonds, which provide you inflation protection, are actually pricing negative yields. They're like guaranteeing locking in negative yields in the TIPS bond market. Then the nominal bonds, they've gone up a lot. The yields have gone up a lot to 230, but it's still, you've got a 7 to 8% inflation number. Now the question is, how quickly will inflation go down? Commodities, yes. So broad commodities are up. They were up last year. They continue to lead the markets this year, but they're acting as a very useful portfolio hedge. And I think the energy sector is as well. And the energy sector, again, had underperformed for a decade. These stocks potentially have, in terms of catch-up room on a pure performance, it's not necessarily that they've just had this huge rally. Of course, they're leading the markets by a lot this year. It's all going to depend on that, again, the future price. And there's a lot of things that I think are supportive for energy prices. In the actual raw commodity futures itself, one of the things we've been talking about on our team, for the last 2 decades, it used to cost you 7% a year to roll commodity futures. And that's because of the shape of the commodity curve. It used to be in what's called contango, where the futures price is much higher than the spot price. And then every month you'd be paying, and people would talk about these commodity futures funds. They don't track spot. Well, it's because they were investing in futures and it cost them on average 7% a year. That is very different today. Very, very different. It's now sharp backwardation, and on some metrics, the sharpest backwardation it's ever been, which means the futures price is below the current price, which is that there's so much demand for current that it's bidding up the current and people don't expect it to last, which means when you roll the commodities, you're actually getting paid.
I don't see a lot of people talking about future when we get past this point with commodities, but I constantly think of just, if I am in the C-suite and I'm looking at my supply chain globally and all the disruptions that I've had over the last 2 years, I got to be thinking about moving some of that back onshore, which I would think could, if that was the case, basic materials and a lot of infrastructure spending would have to be done to really have a robust supply chain and kind of give up some of those better profit margins by being more globally diversified. Are you guys hearing anything about that?
You're picking up on the Twitter zeitgeist beautifully. There was actually yesterday, one of my friends in the industry said that somebody needs to launch a team ETF for the onshoring theme, and that was let's see if I get all of his factors. It was his transports, energy, agriculture, and he said Mexico because of the sort of North America supply chain reshoring. You could also substitute. Somebody said substitute metals for Mexico for the team basket. But I think there is something to that. I mean, we saw it even with COVID, the question of should we outsource some of the supply and logistics halfway across the world in China. And so that was a very political issue. So you're seeing all sorts of reshoring of things. I mean, there's elements of this new remote first world where you could be anywhere. I mean, at Wisdom Tree, we've become a remote first company. And so you could, and I think we're in our work where we're doing a lot of writing, speaking, communicating. Here we're talking with you on Zoom, and like this would have had to be in person. How much, more inefficient if I had to get on a plane? Could we've gotten Aneeka to come over from Europe? That would have been a very expensive plane ride for Aneeka to come to do this recording. But now it's seamless, right? So there is a productivity enhancer of this remote first world, but there are some things that you need to be, that are going to come back for that traditional manufacturing supply chain.
Chris, I think you have some questions.
Let's move on to equities, and we have some global experts with us. So let's get into the big debate of international versus domestic stocks. And our viewers know that we've held a U.S. domestic equity tilt for a long time, and we do tend to follow momentum. So following what's been working the last 10 years, that's not really surprising. But the market's been shifting towards value for well over a year now, and there looks to be a lot of international value. A lot of the indices are value tilted. And Jeremy, I saw you on CNBC a year ago calling for a international outperformance over the coming years. Do you still hold that view?
Well, I mean, so some of it, and it all comes back to the same theme. What's causing the rotation from the NASDAQ and the mega growth stocks to everything else is that inflation and higher rates theme, right? That's supporting energy, it's supporting banks, your more cyclical commodity sectors versus your mega growth. So I think in some ways that is what's been playing out. And certainly this year, even you're seeing like in emerging markets where you had Russia exposure, which is now being priced at zero, still having very large outperformance if it had a value discipline because it was in the commodities and energy sectors. And you would say, like, how could you be exposed to Russia and still be outperforming the S&P by a lot? And that's happening in emerging markets value versus the US. And so I think there's an element of much lower valuations. But you could get pretty reasonable valuations in US small caps. I mean, so the S&P was 19 times forward earnings. We have baskets of US small caps that are 11 times forward earnings. I mean, so you can get pretty good valuations here in the US. And so I think that's one thing to consider. But there are, you go to international value, you get 10 to 11 times earnings in developed, you get 6 times earnings, 7 times earnings in EM. So I think those are part of the structural commodity inflation story as well. And so I like adding that diversification after a very tough period where growth led everything and US tech is the embodiment of that. I think some of that natural rotation could be with us for a few years.
So you are allocating to both international value and developed value and emerging value. Is that how you're approaching emerging? Or are you being a little selective in emerging with some of this Chinese volatility? And you already mentioned the Russia volatility marked down to zero.
So for sure in all of our EM funds, the current equity weight is being marked at zero.
Great. Let's shift to monetary policy and inflation. And this is our first call since the FOMC had their meeting last week and their projections. And I hope you guys got a chance to review those with the dot plots, which are just the future expectations from the members of where they think rates will be in the next year and the longer run. And the median member was actually projecting about 1.75 to 2 by the end of this year. It's a little bit higher than what I was expecting, probably higher than what you were expecting. Do you guys think they're going to be able to get there?
Well, nobody has a crystal ball, but they were only expecting it went from 0.9 to 1.9 in one set of dot plots. Now we have a podcast that we do called Behind the Markets. We had Jim Bullard 3 weeks ago. Bullard is the most aggressive of the Fed people. And Bullard is now saying they need to do 50 basis points at every meeting for the rest of the year. Professor Siegel agrees. And so now the question is, will they certainly came quickly to ramping. They've certainly been very wrong on inflation. They've gotten inflation very, very wrong. So can you trust where they say the terminal rate is going to be with how wrong they've been on inflation so far? And so I think it's actually now more likely that they're even above 2%, I think, by the end of the year. That they've shifted focus. Inflation is now the number one focus. Everybody says, oh, they're going to get scared about market volatility. They don't really, that's not their primary mandate. It's full employment and inflation. Now they do try to factor in the general financial conditions, but Powell said they need to tighten financial conditions to get inflation down. He directly said that. Sort of the quote unquote Fed put may be a lot lower, and they have to. In our view, inflation is going to be with us for some time.
What do you think's happening in the market? Because as he's saying these things, the market is rallying the last 4 or 5 days. So you think the market had fully expected him to be this hawkish?
It's always funny when you get to the events. Once you get past the event, the uncertainty of the event sort of goes down, even if it came in as expected, or even, just the event is over. So there was all sorts of hedging potentially for the event, and then you get past the event and things. So it's hard to read just that one-day reaction, in my view. But so now the question will be, how do they deliver through the rest of the year? So every inflation number will be very important. People are starting to think 50 is the next. The market, when I say people, that the market is starting to price in more of a 50. I would probably bet on 50 at the next meeting. And that, we'll have to see how it evolves as the inflation numbers continue to progress throughout the year.
It's always funny because they give their projections and they don't put their name next to their dots or their projection, but you can see, you can know that's Bullard. That's
Right.
the outlier up there.
We're in St. Louis, so we're familiar with Boulder's opinion anyways. So if we're talking about raising rates, I think the next thing is recession, right? The R word. And I know we've been talking about high prices for quite some time, and the market sell-off has kind of helped that. But now concerns are they going to raise too much too quickly? So then in our minds, we're saying, well, who cares? They're going to do what they're going to do, and then we got to be responsible for it. Are there any sectors that have some asymmetry here that could weather a recession, but there's still some upside that you guys see as constructive at Wisdom Tree?
Aneeka, I've been talking a lot. Do you want to start with anything, and then I'll
Sure.
come in?
Yep, I think this is another case where we tilt again further towards the value sectors. So I think the 3 sectors we've been looking at that have done very well coming out of Q4 2021. If you look at the earnings season, has been energy, the banks, as well as the materials and mining sector. And I think this commodity price surge that we've seen again builds the case for these 3 very sectors, coupled with the fact that we're seeing a more aggressive Fed, a more hawkish ECB. That again bodes very well for these 3 sectors, and these 3 sectors make up a very large part of the value, the value factor. So I think that's where we see quite a bit of opportunity for this year.
And the one thing I'd say about the economy is, in the US, we are not at the moment close to recession. We're at very much full employment. You've got 2 times the amount of job openings as the unemployment rate. I mean, it is a very robust labor market. And you don't see right now energy prices crimping demand even as much as they've risen. I mean, it seems to be very robust and resilient to that. And you have the reopening and all the money that's in the system that you mentioned with the money supply. So it doesn't seem like we're going to recession right at the moment, but obviously things can change, but it seems like a very strong economy.
So then one of the things that, go ahead, Aneeka.
Yeah, I just wanted to echo the same view. I mean, in Europe as well, prior to the invasion, we were seeing European earnings revision estimates at a higher level than the US. We were also seeing a bit of a momentum coming out of the Omicron variant because, a large part of Europe had been locked down, and there was some very strong momentum coming out. So I would say, I mean, we've been hearing that recession word continuously linger on, coupled with stagflation. And obviously Europe being at a much closer proximity to this war is getting impacted even more. But, growth still remains very intact. As an onset of this war that's taking place, there's a lot of other packages coming into place, such as Germany's focusing on increased defense spending. The EU is putting together a combined package to try and take care of the loss that we've seen from the war. So I think that all of that impetus that could come from these packages has yet to be priced in.
And that gets me to the US dollar, and that's specifically, Aneeka, because we Americans constantly see the world and see everything as a dollar. I think we kind of lose some experience with FX markets and the way that the dollar is used globally, being that it's our local currency. Using the SWIFT, and I know it's a global component, there are a lot of people that are involved in it, but does this have long-term implications for the dollar as a reserve currency, being that there's now a component built into some people's minds that there's some political risk by holding your reserves in dollars?
There could be in the longer term, but for now, the dollar still seems to be, in fact, it's taking the place of being the safe haven currency, especially in times of distress. Look at the yen. It's like the second worst performing currency in the G10 space. Look at the best performing currency in the G10 space. It's the Aussie dollar, because it's, the supply disruptions that we're seeing from Russia are actually benefiting a commodity intensive country such as Australia. But I still believe, and obviously the dollar is doing even better given the wider policy divergence between yen and dollar. But we still see a lot of strength in the US dollar. It's still viewed as a reserve currency.
All right. Well, we wanted to play a quick game as we wrap this up. It's there's a lot of headlines with a lot of buzzwords that I often wonder, is it just clickbait or is there a real concern? Are we dealing with real news here? Some of these we've already talked about, but I just want to just throw that buzzword up. You guys can tell me whether it's clickbait or real, and just a quick summary on why you think that's the case. So one of the buzzwords, why don't you take it off?
Demand destruction. So rising commodity prices, putting pressure on the rest of your basket, leading you into recession.
Yeah, I say it's clickbait.
That was fast.
It is very similar to what Jeremy said. You've locked down a vast amount of population for such a long time. They're just raring to go. They have excess amount of savings, which hasn't been deployed either productively or unproductively. You've got a strong jobs market, be it the US, Europe. You've got unemployment falling. So I think they want to spend that. And you've got oil at around 111. We're not talking about the 150 levels. There's been a correction. So I see that as clickbait.
Jeremy, any take?
I agree. Fully agree.
You agree?
Nothing to add.
All right. Next one, international markets outperforming the US over the next 3 years.
Well, I guess I already made my case that I think that it's very possible. So I'll agree. I'll agree with that one. Real news. It's really valuations, the inflation, the commodity story. It's a little bit of the rotation away from tech, all that we talked about.
Makes sense.
Chinese equities are uninvestable.
That's a tough one. I'd say clickbait. And generally when people say it's uninvestable, that's probably the time to invest. I think the tensions are starting to come off. Even just this morning, you saw Alibaba announce a $25 billion buyback. There's rumors that the anti-IPO are coming finally. That was one of the things that cascaded Alibaba and all these tech companies on a tailspin was the delay of the anti-IPO. That might be coming quite soon. Obviously, there's a lot of geopolitical questions on China. So there's obviously not a non-zero risk that they become like Russia in the future, in the sense of where everybody sort of the cancel China policy is possible. If they invade Taiwan, that is going to be what happens. And I think this is a very good demonstration. Now the question is, will they do that? And our view is I think my sources are saying no, but certainly that's a view that some people have.
You had mentioned the 60-40 portfolio as it's struggling this year, and we've continued to emphasize the need to increase equity exposure for our clients, even if it doesn't fit in that risk profile of balanced, or they do. Stagflation is showing up, oftentimes talking about how commodity prices have gone up more than they did in the 70s. Clickbait, or is this real news?
Clickbait.
I think clickbait. Absolutely, I agree.
And we've touched a little bit about demise of the dollar, or the petrodollar is ending.
Clickbait.
And Well, we've talked about a lot of headlines. They definitely get a lot of clickbait as they're put out there. My experience is whatever is going to cause the market to really have a disruption isn't already in the headlines. It's not known. Is there anything out there that you guys see that really deserves more attention?
Good question.
I think there's one thing, which is, the EU's proposed carbon border adjustment mechanism. So I think the EU is now questioning following the invasion, Russia's invasion in Ukraine, the EU is actually questioning whether they should actually go ahead with the carbon border adjustment mechanism. When Russia produced, just taking a simple example of aluminium, when Russia converts alumina into aluminium, they're actually using hydropower. So their carbon footprint is a lot lower. And hence, when Europe is importing that aluminium from Russia, they're actually lowering their carbon footprint. But now with the imposed sanctions, the EU's focus on the carbon border adjustment mechanism is really coming into a question, and they're really thinking through whether they should impose this, whether they should wait, for the war to end, and they're really rethinking their energy transition.
Wow, well, what a great call, guys. We really appreciate your time. We appreciate your insight. Any of our viewers that are listening and they want to talk about their portfolio or want to reach out to a lead advisor, we'll put our number up here as well as in the description. Thank you for joining us. And for our viewers, we hope to see you next week. Any last words that you guys want to say?
Well, we appreciate you having us both on. Thanks for being, great supporters of Wisdom Tree, and thanks for having us on.
All right. Thanks, Aneeka. Thanks, Jeremy.
Thanks, guys.